You are sitting at a desk. It is a quiet morning. You are typing a simple number into a computer. You hit enter, but your finger slips. You type the decimal point in the wrong place. Most of the time, this is just a small mistake. You delete it. You fix it. You move on. But what if the machine does not let you fix it? What if that single keystroke vanishes into the digital ether and triggers a cascade of events that wipes out billions of dollars in seconds? The real answer is far stranger than a simple typo. It is a story of how human errors are amplified by machines that move at the speed of light, and how the greatest stock market collapse in history was triggered by a decimal point. To understand how this happens, you have to look at the invisible architecture of the modern financial system. It is not a physical place anymore. It is not a room full of shouting men in colorful jackets waving paper tickets. It is a digital landscape. And in this landscape, speed is everything. The stock market is now a war of microseconds. Firms spend billions building fiber optic cables straight through mountains just to get their data fraction a millisecond faster than their competitors. In a world this fast, a human cannot hit the stop button in time. The damage is done before the screen even updates. In December of 2005, a trader at Mizuho Securities in Japan was sitting at his desk. He had a simple task. He needed to sell one single share of a recruiting company called JCOM. The price was supposed to be 640,000 yen, but his fingers slipped. He misplaced the decimal point. Instead of selling one share for 640,000 yen, he typed an order to sell 640,000 shares for 1 yen each. The Tokyo Stock Exchange had a system in place to prevent this. It was supposed to block absurd orders. But that morning, the software failed. The system allowed the trade. A single keystroke wiped out $330 million in an instant. The trader tried to cancel the order, but the machine had already processed it. The damage was done. But that was just one firm losing money. To trigger the greatest stock market collapse ever, a tiny error has to do something much worse. It has to wake up the machines. Today, the stock market is a landscape of algorithms. Cold, calculating computer programs moving billions of dollars in milliseconds. When you make a trade, you are not interacting with a person. You are interacting with a machine that is programmed to react to the market faster than humanly possible. And in this world, a human mistake does not just cost money. It creates a reality that the machines believe is true. On May 6, 2010, the United States stock market experienced the fastest, deepest collapse in history. It is known as the flash crash. The Dow Jones Industrial Average plummeted nearly 1,000 points in just 5 minutes. Trillions of dollars evaporated into thin air. For a brief, terrifying moment, shares of major, stable companies were trading for pennies. Procter & Gamble, a massive consumer goods company, dropped from $60 a share to a single penny. What caused this financial apocalypse? It was not a Wall Street villain. It was not a geopolitical crisis. It was a decimal point. Andrei Kirilenko, the chief economist of the Commodity Futures Trading Commission, led a massive investigation into the flash crash. He and his team spent months analyzing millions of trades. They discovered that a single trading algorithm had placed a massive sell order into market. The algorithm was programmed to execute a large trade. It was supposed to adapt to the market, but it did not account for the current market conditions. It just executed a blind, aggressive sale. It was a mathematical error, a decimal point in the wrong place in the code. When that massive algorithmic sell order hit the market, the high-frequency trading computers saw it. These are computers that buy and sell stocks in fractions of a second. They do not think. They do not pause to ask if the price makes sense. They simply saw a massive amount of selling pressure. Their programming told them to panic. The algorithm started aggressively selling everything they owned to avoid being left with worthless stock. This triggered other algorithms to sell. It was a digital stampede, a feedback loop of automated fear. The machines were feeding on the chaos created by a single, poorly programmed execution. The market did not crash because the economy was bad. It crashed because a machine made a mathematical error, and 1,000 other machines blindly followed it into the abyss. Didier Sornet, a physicist who studies systemic risks in financial markets, calls these events Dragon Kings. He explains that complex systems, like the stock market, are vulnerable to extreme events that are born from their own internal feedback loops. A small spark, like a misplaced decimal, ignites a chain reaction that the system cannot contain. The algorithms are incredibly fast, but they are not intelligent. They do not understand context. They do not know the difference between a genuine market panic and a fat-fingered typo. They only know the numbers. And when the numbers are wrong, the machines do not hesitate. They just execute. Take the case of Knight Capital in 2012. They were a massive financial firm that handled a huge percentage of all stock trades in America. One day, they uploaded new software to their trading computers, but they made a mistake. An old, dormant piece of code was accidentally reactivated in the system. It was a decimal point error in the code itself. The system was telling the computers to buy high and sell low. It was the exact opposite of what a trader is supposed to do. When the market opened, the Knight Capital computers went rogue. In just 45 minutes, the algorithm executed 4 million trades. It lost $15 every single second. By the time a human intervened and pulled the plug, the firm had lost $440 million. It nearly bankrupted the company. A single, misplaced line of code triggered a catastrophic collapse that took the entire market by surprise. The humans were helpless. The machine was too fast to stop. Why has the system not been fixed? Because the speed of the market is its greatest feature and its greatest flaw. Firms spend billions to be the fastest, but speed without wisdom is dangerous. Today, markets have circuit breakers, automatic pauses designed to stop a panic. If the market drops too fast, trading stops for 5 minutes to let humans catch up. But in the millisecond before the circuit breaker trips, a single misplaced decimal can still cause billions of dollars in damage. The system is fundamentally fragile. It is a delicate balance of human intent and machine execution. Dr. John Bates, an expert in complex event processing, has spent years studying how algorithms interact. He points out that these systems are designed to optimize for speed, not for wisdom. They amplify our actions. They magnify our errors. You experience a smaller version of this every day. You rely on autocorrect to fix your typing. You rely on algorithms to sort your email. You rely on GPS to route your drive. When these systems work, they make your life seamless. But when they fail, the failure is instant and invisible. You send a message to the wrong person. Your email gets lost in spam. Your GPS routes you into a lake. You do not realize a mistake until it is too late to fix it. The same thing happens in the stock market, but the stakes are much higher. When an algorithm makes a mistake, it does not just send a text to the wrong person. It can wipe out a company. It can crash an economy. The algorithms are just following the rules that humans wrote for them. And when the rules are wrong, the results are disastrous. The greatest collapses in financial history are not usually caused by evil masterminds. They are caused by tiny, mundane errors. A misplaced decimal, a bad line of code, a finger hitting the wrong key. The financial system is an incredibly complex machine, but the humans operating it are still prone to the simplest mistakes. And when those simple mistakes are amplified by algorithms that move at the speed of light, the results can be catastrophic. The stock market is supposed to be a reflection of human value and economic progress. But more often than not, it is a reflection of our own errors, scaled up to catastrophic proportions. So the next time you make a typo on your phone, or send an email to the wrong person, take a breath. You are lucky. Your typo did not trigger a global financial meltdown. Because as the history of the stock market proves, sometimes the most powerful force in the world is not greed or fear. It is a misplaced decimal point and a single keystroke.